Good morning, everyone. I trust you're all starting your day refreshed and, perhaps with a steaming cup of coffee in hand. I'm Jason Pries, and it's my pleasure to welcome you to this bright morning as we delve into a wealth of insights and opportunities. Today I've prepared something special for you. An enlightening presentation that unlocks the secrets of asset allocation and portfolio construction. In the financial world, every decision counts. It's about shaping your future, securing your investments, and optimizing returns. And here at Pries Capital, we take these matters seriously. In this presentation, we'll unveil the art of how top portfolio managers implement our innovative macroeconomic research and financial market strategy. So sit back, sip your coffee, and get ready to embark on a journey through the intricacies of asset allocation and portfolio construction for November 2021. It's time to unlock a world of financial possibilities. Shall we begin? I'm confident that what we're about to delve into will be tremendously valuable, not only for seasoned wealth advisors within our network but also for the brilliant community of DIY investors who share my passion for this world. If I weren't doing this professionally, I'd probably spend my days engrossed in the world of investing. It's a genuine passion of mine. Today I've curated a collection of slides that are not only informative but also visually engaging. These slides will serve as insightful visualizations that will guide us through this journey. And don't worry, I promise to keep it concise, taking no more than 15 to 20 minutes of your valuable time. Before we proceed, it's essential to mention the standard disclaimer: everything I share here is for informational and educational purposes only. With that said, let's dive into the heart of our presentation and uncover the keys to successful portfolio construction. Now let's embark on our journey into the world of financial strategies, with a particular focus on a concept that I believe is the cornerstone of understanding portfolio construction. This approach is both insightful and accessible, making it an excellent starting point for investors of all backgrounds. We owe this framework to Ray Dalio at Bridgewater Associates, a luminary in the investment world. If you're intrigued, I encourage you to explore the Bridgewater All-Weather Story, where you can find a detailed article on this very formula. At its core, we view an investor's total return as a function of three key elements: cash, beta, and alpha. Now, for those of you already familiar with these terms, this will serve as a refresher and provide valuable insights into constructing portfolios. But for those who may feel like we're speaking a foreign language, fear not. This presentation is here to demystify these concepts and make them accessible to everyone. Shall we uncover the magic behind this formula and unlock the secrets of total return? Now, we all know that fiat cash is controlled by central banks, and it is not a great investment over the long run and over time because it gets devalued throughout time. And taking a closer look at what we refer to as beta, a fundamental component of your portfolio. Think of beta as your exposure to the public markets' equity and fixed income realms. This encompasses assets such as the S&P 500 in the equity markets. Additionally, it includes the traditional 60-40 portfolio, which, by the way, can take various forms like 80-20 or 40-60, depending on your preferred equity to fixed income allocation. This traditional portfolio model, which has stood the test of time for the past 2 to 3 decades, is often attributed to the pioneering work of Mark Woods. Essentially, it's rooted in the principles of the Markowitz portfolio model. What sets this portfolio apart is its ability to consistently outperform cash over time. In essence, beta is your gateway to long-term growth and stability, providing you with the potential for substantial returns compared to simply holding cash. It forms a solid foundation in the world of portfolio construction, offering a reliable path toward your financial goals. So let's delve deeper into the dynamics of beta. It's crucial to understand that over time, betas tend to rise collectively, making them a compelling asset class that consistently outperforms cash. While there are no absolute certainties in the realm of investing, the upward trajectory of betas relative to cash is one of the closest things we have to a sure bet. Take, for instance, the traditional 60-40 portfolio, which has demonstrated this phenomenon. Over the long haul, as you navigate the ebbs and flows of economic cycles and market volatility, this portfolio proves its mettle by outpacing cash. This knowledge is immensely valuable, particularly during challenging times when 60-40 portfolios might face headwinds, such as in deflationary market scenarios. Even when cash appears to reign supreme in the short term, during recessions or deflationary periods, understanding that your portfolio will prevail over cash overall can help you stay committed to your investment strategy and goals. I've also included the 401k in this discussion, as it essentially represents your mutual fund lineup, a variation of the traditional portfolio model. The reason for categorizing it under beta rather than alpha is due to its inherent limitations. It can be sensitive to left-tail risk, and in our current low-interest rate environment, investors are pushed toward higher risk assets. However, it's worth noting that this beta portfolio may not be as diversified as commonly perceived or as diversified as it once was. In the subsequent sections, we'll explore these concepts in more detail and uncover how they fit into your broader investment strategy. Now let's shift our focus to returns and the concept of alpha. Alpha, in essence, represents the excess returns achieved beyond the systemic risk expressed in a portfolio. It's about capturing risk premiums, adhering to a disciplined trading strategy, and of course, the invaluable role of Pries Capital in this process. As a seasoned professional in the industry, I can't emphasize enough how heavily I rely on our partnerships and the expertise here at Pries Capital to add value and implement the alpha strategies we've developed. They are a crucial partner in my quest to deliver superior returns for our clients. Moreover, I passionately believe that Pries Capital's insights can be harnessed not only to enhance alpha strategies but also to optimize your beta portfolio. Within the traditional 60/40 framework, Pries Capital's expertise can play a pivotal role in refining your asset allocation strategy. This intersection of alpha and beta within your portfolio is precisely where we'll be dedicating our attention today. So let's dive into the specifics and explore how Pries Capital's insights can elevate your investment strategy within the confines of the traditional 60/40 model. As we delve into your beta portfolio, a concept you're likely familiar with from my normal insights. At Pries Capital, we employ an asset allocation framework time series that anticipates shifts in the economic environment, aligning our strategies with the evolving macro regime. This process is akin to a chess game, where the goal is to gain foresight and position ourselves ahead of market moves. The aim is to be proactive rather than reactive in our asset allocation decisions. Visualizing this over time, you'll notice the strategic shifts within our asset allocation approach, aligning with the ever-changing economic landscape. To illustrate, let's consider how this framework can be applied to the traditional 60/40 portfolio. In your traditional asset allocation, you'll typically find a 60% allocation to equities and a 40% allocation to fixed income. Within the equity portion, the majority is often invested in U.S. large-cap stocks, exemplified by the S&P 500. However, diversification extends to include allocations to small-cap and mid-cap stocks, international developed markets, and emerging markets. This is a common framework that shapes how asset allocation is structured. Turning to the fixed income component, it includes various instruments such as treasuries, corporate investment-grade bonds, high-yield bonds, and alternative sources of income. Within our asset allocation framework at Pries Capital, we consider various macroeconomic environment regimes that can impact asset classes differently. These regimes include Goldilocks, reflation, stagflation, and deflation. Let's explore how different asset classes perform in relation to these economic environments. First is a Goldilocks environment. Emerging markets tend to thrive in a Goldilocks economic environment, where conditions are just right for growth. International developed markets also perform well, given their somewhat cyclical nature. Small and mid-cap stocks often flourish in this scenario. Second is a reflation environment. International developed markets often exhibit robust performance in a reflationary economic environment, thanks to their cyclical nature. And then there's stagflation and deflation environments. These economic environments can be challenging for equity markets, including the S&P 500, as shown in our backtests. However, it's worth noting that the S&P 500, being one of the most liquid equity markets globally, has occasionally outperformed more cyclical and risky market segments when liquidity dries up, a common occurrence in deflationary environments. In these situations, treasuries tend to perform well. Still, many portfolios, including the traditional 60/40 allocation, often underweight treasuries. It's a consensus view that, in order to outperform the aggregate bond index, which comprises 2/3 treasuries with a 6.5-year duration, taking on some credit risk can be beneficial over the long term. Hence, these portfolios often have limited exposure to treasuries, especially those with long durations. Instead, they are often diversified into corporate and alternative income assets, which perform well in Goldilocks and reflationary environments but may struggle when liquidity becomes scarce during market stress. Now let's delve into an exercise on how you can utilize Pries Capital's signals to construct an asset allocation within this traditional portfolio framework, whether it's for a personal 401k or for wealth management professionals handling family offices. Moving on to the next slide, we have a graph that compares the U.S. markets, represented by the blue bars, to the internationally developed markets, represented by the red bars, and their respective sector weightings. The gray bars represent the difference between the two, shedding light on the key sector allocation differences between these markets. This top-down analysis can be invaluable when making asset allocation decisions. Let's break down the graph. 1. Basic materials. International markets have a significantly higher exposure to basic materials compared to the U.S. This sector includes industries related to natural resources and commodities. 2. Financials. The international markets also have a more substantial allocation to financials, encompassing banking and financial services. 3. Energy. Energy is another sector where international markets carry a heavier weight, reflecting their involvement in the global energy landscape. 4. Industrials. Industrials, an inherently cyclical sector, also show a notable overrepresentation in international markets. These sector discrepancies underscore the importance of a nuanced approach to asset allocation, considering the unique sector exposures of different markets. The data provided here can be a valuable tool for optimizing your portfolio allocation strategy, whether you're a DIY investor or a wealth advisor looking to incorporate Pries Capital's insights. Let's delve deeper into these sectors and their performance in the reflation economic macro regime. It's worth noting that all of these sectors tend to thrive during periods of reflation. However, we must acknowledge that we consider the likelihood of a reflationary economic environment to be relatively low in the coming year. With this in mind, one strategic approach might be to underweight international developed markets compared to other markets and sectors that historically perform better in stagflation and deflationary economic environments. Now let's focus on the technology sector, where many growth companies are concentrated. In a stagflationary economic environment, characterized by slowing economic growth and rising inflation, investors tend to pay a premium for growth opportunities, and the technology sector tends to fare well. It's noteworthy that the S&P 500 has more than a 10% overweight allocation to technology compared to international markets. Understanding these sector dynamics is vital when fine-tuning your asset allocation strategy. Whether you're considering tactical or strategic adjustments in your asset allocation framework, it's crucial to analyze sector compositions across different asset classes and markets. For instance, if you're inclined to reduce exposure to the reflation regime, you may opt to underweight international markets in favor of U.S. markets. This level of sector-specific insight can help you make informed asset allocation decisions and leverage Pries Capital's expertise effectively in your investment strategy. Let's shift our focus to a modified 60/40 portfolio asset allocation following the adjustments we discussed. By making these changes, you'll have increased exposure to the U.S. market, reduced exposure to the reflation regime, and a more significant allocation to treasuries relative to corporate bonds and alternative income sources. Additionally, we've reduced exposure to small-cap stocks, which tend to underperform in stagflation and deflationary economic environments. Instead, we've allocated some of those funds to emerging markets. The rationale behind this adjustment partly lies in China's prominent role in the global macroeconomy. China, as one of the world's largest economies, holds considerable influence. Historically, they have been highly proactive in implementing monetary policies and stimulus measures. This behavior positions them as a leading indicator for global economic recoveries. While the U.S. often leads during economic downturns, China leads in recoveries due to its substantial presence in world trade. It's crucial to note that China has expressed its intention to exercise prudence in its monetary and fiscal policies. While it's expected that China will rebound and reaccelerate in 2022, some uncertainties remain. Consequently, I'm cautiously optimistic about this trade, and as I already have exposure to China and emerging markets, I'm not yet certain about going overweight in the emerging world. Now let's turn our attention to the limitations of the traditional 60/40 portfolio. In this section, I want to draw attention to insights from Diego Pereira and his book, The Anti-Bubbles. Pereira offers valuable perspectives, and he also has an investment product that addresses some of the limitations and tail risks associated with the traditional 60/40 portfolio. Pereira aptly describes the current investment landscape as a shift from risk-free interest to interest-free risk. The relentless pursuit of yield has led to the creation of portfolios that appear diversified but are in fact heavily reliant on government and Federal Reserve support during times of crisis. This reliance can create a false sense of diversification and exposes portfolios to the risk of global synchronized bubbles. Consider the various asset classes in the market, from U.S. equities to high-yield credit to government bonds. Surprisingly, they all share a common thread: they thrive when the dollar depreciates, interest rates fall, volatility decreases, and their correlations remain stable. However, as we've seen, these conditions don't hold during periods of market stress. The events of March 2020 serve as a prime example. The quest for yield has led investors to explore strategies that generate alpha in portfolios. Yet when volatility surges, interest rates rise, and the dollar strengthens, conditions we're currently navigating, it puts tremendous pressure on traditional 60/40 portfolios. Many regions have already hit the lower bound, with some even experiencing negative interest rates. As a result, investors are pushed further out on the risk spectrum. When this unwinds, it can lead to sharp and unpredictable market movements, affecting the stability of 60/40 portfolios. Now let's delve into an important aspect of the standard portfolio: it doesn't fare well during the negative tails of the distribution function. In the world of investing, we've learned from various seasoned professionals and mentors that these fat tails, which indicate extreme market events, occur far more frequently than the typical bell curve predicts. As I have previously emphasized, and one of the compelling reasons to engage with Pries Capital, is the ability to proactively avoid and mitigate these risks. It's a fact that the standard portfolio can experience significant drawdowns of 15 to 20% once every 5 years, or even 2 to 3 times within a decade. These downturns are common. That's why both in my professional role and my personal investments, I rely on Pries Capital's macroeconomic research and framework to help counteract the tail risks inherent in the standard portfolio. As we examine how the portfolio behaves in various economic environment regimes. In Goldilocks and reflation scenarios, this portfolio truly shines. It thrives thanks to its diversified exposure to emerging markets, international assets, small caps, and high-yield investments. Take the example of 2017, a year when emerging markets saw impressive growth. Additionally, the first half of this year demonstrated the portfolio's strength in a reflation environment, with allocations to international developed markets, U.S. value stocks, and short-duration bonds. It's worth noting that the common perception in the financial world often leans towards rising interest rates and concerns about duration risks. This apprehension leads to a reluctance to hold long-duration treasuries, which can actually perform well in a stagflation regime when the yield curve flattens. In a stagflation economic environment, the standard portfolio may survive but doesn't necessarily thrive. Its struggle becomes evident because it lacks exposure to commodities, long-duration treasuries, and other defensive assets. However, it usually maintains a significant allocation to the S&P 500, which includes tech stocks. Tech companies, particularly the FANG names, are somewhat insulated from stagflation and can even benefit from an economic slowdown due to their robust growth. Where the standard portfolio truly encounters challenges is in the deflation economic environment regime, as historical data and backtests reveal. In such circumstances, it becomes apparent that the portfolio doesn't include sufficient cash or currencies as an asset class, lacks substantial treasury holdings due to the pursuit of credit and liquidity premiums in fixed income markets, and often overlooks gold and other defensive assets. While it's important to remember that the beta portfolio will outperform cash over time, it primarily thrives in Goldilocks or reflation economic environments and faces difficulties in the bottom quadrants, namely stagflation and deflation. Now let's dive into the intriguing realm of alpha portfolios. To grasp the essence of alpha, it's essential to recognize its distinct characteristics. In the world of investments, betas are relatively few in number and generally inexpensive to obtain. On the other hand, alphas or active trading strategies are virtually limitless and often come at a premium cost. Understanding alpha is crucial because surprisingly, many individuals, including professionals in the financial industry, have misconceptions about it. While they know it's beneficial and seek positive alpha, they might not fully comprehend what alpha truly represents. Mathematically, alpha is framed as returns exceeding the systemic risk expressed in a portfolio. To simplify, imagine 2 scenarios. 1. The market delivers a 10% return, and an individual's portfolio yields 12%, but their portfolio's beta is 1.3. Given their risk exposure, they should have achieved a 13% return, but they only reached 12%. In this case, their alpha is actually negative 1%. This means that, despite outperforming the market nominally, their risk-adjusted performance is in the negative. 2. Another portfolio generates an 8% return but has a beta of only 0.5. Despite falling short of the market's nominal return, this portfolio generates a 3% alpha. On a risk-adjusted basis, it demonstrates excellent performance. In essence, the second portfolio with its positive alpha may actually be a more attractive choice, even though it didn't beat the market on a nominal basis. This example underscores the importance of evaluating returns not just in isolation but in the context of risk. Now, why should you care about alpha portfolios? They serve as valuable tools to mitigate some of the tail risks associated with cash and beta exposures, offering a means to potentially enhance risk-adjusted returns. Now let's explore how you can incorporate alpha into your portfolios. There are a couple of routes you can take. 1. Professional money managers. You can enlist the services of professional money managers who specialize in capturing various risk premiums. These managers can include value and growth specialists, long-short strategy experts, or those well-versed in navigating private markets to harness the liquidity premium. 2. Independent, savvy investors. Alternatively, if you're among the ranks of independent astute investors, wealth managers, or family offices, you have the opportunity to utilize Pries Capital's framework to actively seek alpha in your portfolios. We view this pursuit of alpha as providing investors with a comprehensive form of diversification. This approach is especially valuable because the traditional 60-40 portfolio is susceptible to the full spectrum of tail risks. By integrating alpha strategies, you add an extra layer of resilience and adaptability to your investment approach. As we're getting close to the end, I want to share a valuable tool that has helped me understand and interpret market dynamics of reading the tape. For a long time I heard people talk about reading the tape, but it seemed like a cryptic concept. So let me shed some light on how you can use this process effectively, utilizing insights from Pries Capital. 1. Month-on-month Sharpe ratio dispersion table. This is like the current tape of the market. The Sharpe ratio is a measure of risk-adjusted return for a financial portfolio. In this table you can see what the market is currently pricing in. For instance, you'll notice that Tesla and Microsoft, two of the top 10 largest components of the S&P 500, are leading in the current tape. This suggests that investors are favoring more liquid markets. There's also positive dispersion in consumer staples and utilities, which typically aligns with a stagflation or deflation economic environment regime. In essence, this table provides a snapshot of the current market sentiment. 2. Using economic expectations as projections, these insights from the current tape can help you project what the economy might do going forward. By understanding where the market is currently placing its bets, you can make more informed decisions about your portfolio and asset allocation strategies. So remember, reading the tape isn't about deciphering a mysterious code, it's about using data like the Sharpe ratio dispersion table to gauge market sentiment and align your investment strategies accordingly. Now let's shift our focus to the expected tape for the next 3 to 6 months. Based on our analysis, we anticipate a transition between the stagflation and deflation economic environment regimes during this period. This prediction aligns with the current situation in November, where we find ourselves in the stagflation regime from a top-down macro perspective. Interestingly, this is precisely what the market is pricing in at this moment. What's crucial to understand is how we use Pries Capital's macroeconomic research and financial market strategy to not only assess the current market sentiment but also to project what lies ahead in a 3 to 6 month window. By doing so, we gain valuable insights into the market's expectations. It's worth noting that monitoring changes in the current tape is essential. We pay close attention to whether these changes are consistent with our projections or if they diverge from our expectations. This vigilance allows us to adapt our strategies effectively and make well-informed decisions in a dynamic financial landscape. And that concludes today's presentation. If you have any questions or would like to discuss further, please don't hesitate to reach out. Before I go, for those of you watching this, I want to express my gratitude for your time and attention. If you found this video informative and would like to explore more insights, please visit our website at priescapital.com. We eagerly anticipate the opportunity to work with each of you, and I wish you a fantastic rest of your day. Thank you once again.